think I know I love it.
All right, welcome back to How to Invest in Commercial Real Estate. And today is an exciting day because we are talking about a new deal we are funding. Awesome. Love new deals. And it's been a little bit of a slower time, interest rates going through the roof. It's interesting how deals are penciling out. You obviously need a higher cap rate or something it's got to give to make the increased cost of the debt work, right?
Yeah, where is it located?
So anyway, this new deal is...
Get on with it. Tell us where it's located.
Okay, so the new deal is in Owasso. It's in Owasso, which is exciting because we're based in Owasso, do a lot of work all over the country, but we're based in Owasso. So this is an Owasso deal, and we are buying 2 acres to develop a multi-tenant strip center and a ground lease. So that's kind of exciting. We got the opportunity through the Woodmont Company. It's not with the Woodmont Company. We got the opportunity through the Woodmont Company. So another massive plus to that relationship. But this group is called Retail Partners. And they do retail development, a lot in Dallas, a ton in Dallas actually, but all over the country.
Dallas as well.
Located in Dallas. Yeah, and they've got a pretty big leasing team, and they're bringing some what I would call heavy hitter tenants to the field here. So what's important about this deal is that just like Retail Partners, our new partner in this retail deal, with us is they don't like taking on the lease up risk, right? So with this deal, it's a high development budget when you look at what we're building. But when you look at the quality of the tenant and the brand new lease that we're getting and the location, it really starts to make sense. So we can dive in a little bit now.
At this point, are all the leases signed for every space?
All the leases are signed.
Okay.
They're supposed to all be signed. We're going to double check that, but they're supposed to be signed before we fund the deal.
So it'll be 100% pre-leased prior to start of construction.
Correct.
Nice.
Yep. So there's 4 tenants in the strip center, and you have a ground lease. So the ground lease is salad and go. It's a drive-through concept. You get a salad and you go. It's very simple.
Yeah, that sounds simple.
Why don't you explain how a ground lease works?
Yeah, that's a great concept, and Joel's done 1 or 2 ground leases as well. Yep. But generally speaking, you provide the land, you provide some sort of pad, typically. Could go either way, but typically with utilities on the pad. And then once you deliver them that pad, they typically have some sort of time period of 90 to 120 to 180 days to build their building. Mm-hmm. And then rent commencement starts on this specific deal 6 months after we deliver the pad. So it'll take us a few months to deliver the pad. It'll take them about 6 months to put their building on that pad. And it's really interesting how these work because sometimes they're almost completely prefabricated buildings that they set on top of this pad, right? It's very fast. To get it up, and then they're going to pay us $75,000 a year for rent for the ground.
And then just like a developed building, you can go sell that ground lease.
Correct. Yeah. So they're going to have costs and obviously putting their building on our pad significantly less, and they're going to pay us rent in the form of ground lease rent, and we're going to sell that just like you would a building. And the beauty about a ground lease is they typically sell. I think they typically sell for a better multiple, a bit of a higher return because of the inherent security of the deal, right?
Yeah, you can think about a ground lease as the best form of an absolute net lease deal, where the owner owns the land and every other responsibility is on the tenant to pay. All costs, utilities, taxes, insurance, everything. All you do is just own the dirt. And what's good about most ground leases and why they might sell for a little lower cap or a higher price is that any of the improvements that are made to the property above and beyond the land, well, whenever they stop paying or whenever the lease is up, you get that. They don't just get to rip the building down and take it. Those stay with the property. So sometimes it can be worth more having those improvements paid for by the tenant.
Right, because when you have a building, right, and the tenant comes up for renewal, you're negotiating over that specific space. If you have a building on my ground and your ground lease expires and you don't renew, like you said, you don't get to take anything with you. So your risk of loss is probably higher, right, on the tenant side.
Yep. And, obviously the tenant has the basis of the building, but the ground rent, let's say they paid cash for some of their improvements. The ground rent isn't super high comparatively to them going and renting another building. So it gives you some upward momentum on the rent when and if you have to renew it.
Yeah, and for us, we probably got $700,000-800,000 worth of land costs we're buying to put the ground lease on, but it should work out
So that's
great.
that's on about half of the land or a third of the land. Tell us about the other 4 tenants.
Yep. So the other part of the deal is an 11,000 square foot 4-tenant retail deal. The first tenant is Kava, which is the new concept that bought Zoe's, if you've eaten there, kind of a Mediterranean quick service retail type of vibe. And when Kava bought it, it turned into like a Mediterranean Chipotle.
Okay. Interesting.
So you get that. That's great credit, great little tenant. The next one is Floyd's Barbershop. You have a franchise of Floyd's Barbershop out of Dallas. They've got a ton of locations down there. So you'll get that guarantee, the corporate guarantee from the franchise.
It's kind of a high-end barber, or
I've never been to it, to be honest.
I mean, we need to figure that out. It's probably not like Supercuts.
I've heard of
It's
it,
not
though.
a Supercuts.
Because they're paying some pretty decent rent.
It is. It's more like an elephant in the room.
Okay, boardroom maybe.
Yep. The next one is called Hollywood Feed. I had to ask about this one. I didn't know anything about it. Our buddy Brian knew all about the upscale dog place.
Well, there's one 2 miles away from here.
Yeah, there's one at 101st and Memorial. Yeah, high-end dog food.
High-end dog food.
Or high-end pet food.
91st and Yale. High-end pet food and animal supplies, basically. So.
And this guy told us on the phone, apparently one of their claim to fame is they deliver the dog food for free. So that's, how you're paying way too much for dog food. And the next one is Mod Pizza, which is like I don't know if it's like a blaze where you're actually making the pizza or if it's just to go. I think it's more of like a blaze where you're going in and actually making the pizza.
But quick, they're pretty quick.
Super quick. They're personal pizzas and you're eating it there. Yep. So it's not like a Papa John's or a Domino's or something like that.
Okay, so tell us what's the equity raise, and then what's the structure of the investment for the investors? What kind of returns are we expecting?
Great question. So the equity raise is $1,450,000. That's being injected into the deal with retail partners. We're getting an 80% loan to value, so that's our equity due at closing. That'll fund the $6.8 million total development cost. So that'll be locked up for a year. It'll take us 6-8 months to build the building, get everyone open, get the ground lease delivered, make sure everyone's open and operating, build the package, put it up for sale. Very similar to how we do with the Kitty Academies or the El Luchador restaurant that we did in Vegas. Very similar to those. The return profile, so we're evaluating on an IRR. There's not going to be any distributable cash until the sale. We're assuming to exit the ground lease at around a 5 cap. And exit the building at around a 6.5 cap ish. There's margin to this on either side. It could be better, it could be worse. And our returns to the investor on the $1,450,000 equity raise is 18 to 33%.
Okay, 18 to 33%. That's over 1 year.
Over 1 year. 18 is obviously selling way closer to a 7 cap. 33 is selling way closer to a 6 cap.
My guess would be that you're going to get closer to a 6 cap than a 7 cap on the brand new 4-tenant retail deal. I imagine there's a little bit of risk at hitting a 5 cap on the salad to go. I mean, you could hit a 4.75, but you also hit a 5.5. So I think there's probably more risk trying to hit the 5 than there is hitting a 6.25.
Typically, do you think those two would sell together or independently, the strip and the ground lease?
I think independently. They're two different returns. They're two different risk profiles.
Yeah, I would agree. It's probably a 1031 buyer for sure on the ground lease, and the multi-tenant retail is, like I said, just a little different return profile.
So what I love about this deal, I'm from Owasso. I've been in Owasso 20 years now. These are new concepts to Owasso, right? It's not some chicken place. Like everyone's got like 50 chicken places, some new way to fry chicken and some fancy sauce that sucks and tastes like the others. This is not that, right? It's new, interesting tenants. Another thing I love about it, it's a fantastic location. It's located right behind J.C. Penney anchored power center, massive big box.
Oh, J.C. Penney, they're killing it these days.
Yeah.
Solid.
So it's in a great location. So
Okay,
this is the
hopefully
biggest retail trade area of Owasso. You've got an Olive Garden, a Bricktown Brewery, and Chick-fil-A. Each of those do $5 million a year in sales, and they're less than half a mile away from this property.
Okay, so location's good.
Location's great.
I like this brand new.
It is.
Quality tenants. Do the leases have bumps?
I believe so. I think it's 2 or 3% annual bumps. I believe so.
Okay. What else do we like?
It's fast. What I like right now is
what is the schedule on it as far as getting it built?
I think they're trying to be open with the multi-tenant strip center at the end of the first quarter of next year.
Okay, that's pretty fast.
Yeah, so they will.
Really fast.
I mean, this deal will have launched the investors by now. Most likely, will have filled up by now, right?
Yeah, I mean, it's only a $1.45 million raise. It's gonna go pretty fast.
It's going to go very fast.
So not as many deals around. We've had investors calling us actually and emailing us asking when our next deal is. So,
is there any? I was just thinking upside. Is there any potential upside in the construction costs?
Absolutely. So right now, the developer Retail Partners is out of Dallas. They've got a construction company that they use a lot. They're supposed to be great out of Dallas, and they've bid guaranteed maximum based on the elevations and site plan and tenant work letters we have. Obviously, if they're worth a crap at all, they're going to have bid high on this and have room to wiggle down. We still have to do a little bit of architectural work. So yeah, there's room for savings on the budget. We're having our general contractor look at it as well. We think there could be some savings there just with him being local. You know, he's already doing a project for us up in Owasso, so he should be able to be very competitive.
Yeah, for sure.
So there's a little bit of upside there.
All right, let's talk real quick about potential downside risks for the investors.
Yeah, so I think the first biggest, most obvious low-hanging fruit is what happens if you don't sell the building, Joel? What happens if you don't sell it?
Well, if we don't sell, I think our all-in cost is based on a 7.5 cap.
Yep. Yeah.
And so we have a construction loan going in, but we'll refinance that. And I would say 6-8 months from now, expect interest rates in the, probably what they are today. They may come up, they may come back down 5.5%. So cash flow will be a little skinny. I think you'll still cash flow some, but that's a risk that you have to hold on to it. You don't get your big IRR, and maybe we're covering the 8 pref while we rent it out.
So the rates are expensive. You've got very expensive tenants, you've got national brands, and you've got brand new leases. So if these brands default on the lease, it's a clear path to suing them and getting it remediated shy of, some Chapter 11 bankruptcy, I guess.
Yeah, I don't think that's the risk. You have tenants in there that are strong enough that even if their concept isn't working, they're going to stick it out for a few years because they have money, and why shut the location and get sued?
Yeah, right.
But do we know how long the leases are?
I don't know exactly. They'll be at least 5 years, but there's a decent chance some of them are 10.
Yeah, 5 to 10 years. So, I think the bigger risk is if you have to hold this thing for whatever reason for a full 5 years and some of the tenants don't renew, you're going to have a hard time replacing that rent because this rent is for a brand new location. It probably includes TI for the tenant to build out the space to their specification. So, yeah, the risk is if you happen to own this thing 5 years from now, you may only rent it for $30 a foot, and maybe your rent right now is $35 or $36 a foot, or maybe $28. And so I think the location's good enough, and with inflation 5 years from now, you're going to be getting a decent rent, but that'll be a hit to the cash flow.
I'm going to guess we probably have at least 10-year leases on this thing.
I'd like to think so. I don't want to say it because I personally haven't verified that, but the probability of them being 10 years, especially from the tenant improvement build out perspective and the fact that it's a new store, we're fronting that cost to build it out. So it's way less of a burden on the tenant, amortizing that over 10 years instead of 5.
We'll make that obvious what the lease is though when we send this out to the investors. So
absolutely. And by the time this comes out, we'll have probably known and we'll put it up on the screen.
I would think, in just thinking about it, this isn't one that you keep because we don't buy brand new 6.25 cap deals. We don't buy high rent deals. So even if we took less profit, I think our goal would be to exit this as soon as possible, get our money back plus whatever profit, whether it's 25% IRR or even 12% IRR, take it and be ready to do the next deal. I think this thing gets riskier the longer you hold it. And so I think we'll be looking to exit at whatever the market wants to, purchase it at.
I agree. And I think a lot of the values in this specific deal is from spinning off the ground lease. I think you've got way more margin in the ground lease than you do the building, which, should help you because the ground lease, I would think, would sell faster. So that gives you maybe a little bit more flexibility on your basis in the building when you go to sell that. And then I also think it fits the same risk and rent profile as a kiddie academy. Very, very similar, right? The kiddie academies, we have mid to low 30 per square foot rents, 32, 33. I've seen a 36 on a kiddie academy. El Luchador, very similar concept to that.
Yep.
We're going in and we're developing this new building for the tenant based on the fact that we have a signed lease and the corporate credit, which is giving us comfort that they're going to honor that lease, right? To answer your question about them dropping out. Exactly the same as the kiddie academy, right?
I agree. I agree. It's brand new. I think people always want brand new and they always want security. So I imagine we do have long leases on this. And I don't think that there's too much risk that we won't get a buyer, whether we get a buyer at 6 cap versus 6.5. I mean, we still make money at 6.5. We make money at 6 3/4. We make money at 7. It's just a matter of how much.
Correct.
And so, our investors are going to find out 9 months to a year how much they're going to make, and then we're going to give their money back to them, and then we're going to go do another deal. So I think the downside risk is relatively low, given the short exit. And if we can make our investors 25-30% on their money in a year, well, then that's a huge win.
Yeah, and I think to your point about it gets riskier the longer you hold it. I think when we go to evaluate the sale and we get that 6 3/4 cap offer, I mean, if we can't make that work, I mean, we may just sell that and deal with a 20% IRR, knowing that, hey, we haven't gotten another offer or whatever.
Yeah.
Anyway, that is the new deal in Owasso, multi-tenant strip center development with retail partners out of Fort Worth, or out of Dallas, not Fort Worth. We should be closing here in a couple weeks, and the equity raise is probably already full.
Well, but if it's not, come to the website and check it out. Make sure you get a look at it.
Yeah, and while you're there, if you haven't already, make sure to sign up to the investor list. The equity from this deal literally came from that investor list. We type up an email to the people on our investor list. Same thing at Precision. Say, hey, we've got this new awesome opportunity. Here's the deal. Here's the metrics. Here's the upside. Here's the downside. Here's the link to this video. Here's previous performances we've already done. And you have the choice right there to say, yeah, I'm in, or yeah, I'm not. There's been a lot of people over the past few years that have partnered up with us on similar deals, and they've gone great, right? We're still waiting to exit some. Some we're going to hold for a long period of time. We're paying out cash flow. What did we say last quarter between Precision and Criterion? It was $1 million in distributions. And those went to people who signed up to our investor list.
Yeah, and I want to say people that are saying, okay, this has some risk, this has some downside, it has some upside. The thing is, people that are investing with us, their money is typically in the market, okay? And I would ask people, is there any downside risk in the market over the next 6 months?
Yeah.
How have you done the last 6 months?
Yeah.
You're down 20%, down 30%. And the thing is, I don't think that's going to magically just rebound. I think we have some more risk.
Yeah.
And so then you have to say, okay, what if I put it in the bank? I get 0, I get 1%. And so, yeah, we may not hit 30% IRR. We may not hit 20% IRR. But even if we hit 10 or 12, I think it beats 95% of investing alternatives for our investors. Yeah. So that's why they invest in these deals, even with some downside risk, is because the alternatives also have downside. Yeah. So,
great point. Anyway, that's exciting stuff. New deal going on. And I guess we'll catch you next time on how to invest in commercial real estate. Make sure to like and subscribe, and we will catch you next week on how to invest in commercial real estate. Thanks, guys.